In my 34 plus years of providing financial services, one of our strategic plans to pass wealth down is the use of life insurance. I know that shouldn't be a surprise to many people. $1 buys hundreds of dollars of death benefits, so it's very leverageable. Also, life insurance proceeds, if structured correctly, are payable totally tax-free to the named beneficiaries and could be unencumbered by any creditor. It can be a wonderful tool to create legacy and estate equalization. For example, if one child inherits a business, the other child inherits cash. In another situation, it could also be used to create liquidity to pay taxes to the federal government and keep the entire estate intact, such as land and business and buildings for heirs. One particular policy that has been used and designed by the insurance industry for these particular types of planning is called a second to die policy. It's designed for couples who want to share a life insurance policy with specific beneficiaries such as children and grandchildren. The life insurance company only makes a payout to the beneficiary after the last of the survivors die. When we explore second to die life insurance, it becomes a very attractive planning tool. Insuring 2 lives in one policy usually is much more inexpensive than 1 life on a policy. Obviously, due to the fact that it pays at the second death, the mortality expense is spread over 2 lives. In addition, many of my senior clients find that by creating this specific policy and putting it in a protective trust, such as an irrevocable trust, it'll guarantee a legacy for their heirs no matter what happens to their estate, such as if they became disabled and need long-term care protection, and they need to have some of their estate consumed by the costs associated with that care. A life insurance policy in an irrevocable trust over a period of time could avoid all of that. So while second to die life insurance is more affordable, it also oftentimes is easier to qualify for, because even if one person is not that healthy, as long as one of the 2 are healthy, the life insurance usually can be placed. It's a tremendous estate planning tool. It's very customizable. So in choosing a policy, you can really work with a company that really provides for your particular situation. Some drawbacks, of course, would be if the people on the insurance policy decided to divorce. Usually there's a plan provision that causes for that policy to be separated, but it can get sticky. Also, final payouts to heirs may take some time, for the second person has to die before the payout happens. Still, the bottom line is life insurance can be a tremendous tool. If you are in a situation where your spouse won't need a death benefit to make ends meet, the second to die policy is a tremendous tool and a relatively affordable way to provide this tax-free environment for heirs. It also gives you the permission slip to spend down other assets, perhaps that you normally would be thinking to keep for your heirs. Finding the right contract is really important. You need to ask a lot of questions and clearly identify your goals. You should check it out with your planner, and its options worth discussing. Lastly, the cash that accumulates inside these policies could ultimately be used by the people setting up the contract and accessed on a tax-free or tax-favored basis. These are worth exploring, and we'd love to help you with that discussion. Thanks for watching. Please share with others who may find this message valuable.